Hi, my name is Tom Meitzel. I'm a licensed real estate broker in the state of Wisconsin. I'm also licensed as a realtor in the state of Nevada. I also do investing throughout the United States. And today we're going to be talking about some alternative financing methods. Why do you need to consider alternative financing methods? An awful lot of people have gone through foreclosures, short sales, bankruptcies, and you're not going to qualify for a bank loan. If you've been through a bankruptcy or a foreclosure, typically it's going to be at least 2 years till anyone will look at you, and some of the programs require you be out of those problems for at least 3 years. So one of the things you can do is you can use what they call a rent-to-own or a lease-to-own program. They're typically offered in all major cities, major areas, or actually investors who specialize in this type of program. And what it means for you as a buyer is that you're actually going to rent the property you intend to buy. So you're going to have a rental or a lease agreement, and you're typically going to have the option to buy it at a predetermined price. So that way, if the market starts up, you will actually have been locked in at a little bit lower price, but you know what you're going to have to pay for the property over the long haul. Now, typically, the investors that provide these types of deals do charge a higher rent. Sometimes at close, not always, but sometimes at close, they're going to give you a partial credit. Say, for instance, the market rent is $900 in your area. They may charge you $1,200 and then provide you $300 a month back or even more when you close on the property. Now, your option to close could be 1 year, could be 2 years, could be longer. It's all a negotiation with the investors offering these types of programs. But it does give you some time to rebuild your credit. For instance, if you've been out of bankruptcy 2 years, you need a little more time to get your credit scores up. It'll give you the extra time necessary to get that done. But do keep in mind, if you are using a lease-to-own or a rent-to-own program because your credit's not perfect, you need to be taking proactive steps to get your credit repaired during the time that you're renting. There are companies out there that do that, and if you want to send us an email, we'll send you the names of 2 of the companies that our clients have successfully used. But it gives you the time to rebuild your credit, but some of the investors are also going to require a down payment. One of my acquaintances does this full-time in Milwaukee, Wisconsin, and he'll charge $3,000, $4,000, $5,000 up front on a $50,000 home. And that is non-refundable. If you don't close on the property within the 2-year time frame he gives you to close, you don't get that money back. So there is a risk to the buyer if you're not able to close on the transaction in the time frame. Plus, any higher rent that you paid will also be gone if you haven't done it. Now, why would sellers do this? Well, frankly, it's a great cash flow. What a lot of these investors will do is they'll buy up distressed properties at an REO or a sheriff's sale. These properties might be in poor condition. The investors will come in, fix them up, add quality to the property, then resell them to you or rent them to you at a higher price with an option to buy it at the higher price. So they make money on the spread between what they bought and paid to fix it and what they sell it to you for, as well as the interest rate that they're going to get, or the higher rent that they're going to get, is significant, and it's a much better return than they're going to get in a lot of other investments. Plus, if you don't buy the property at the end of the lease period, that property goes right back to the investors and you've lost anything that you've paid or put forth. So it can be a great advantage to you, but to the seller, they don't really care if you buy it or not, because if you don't buy it, they're simply going to do the same thing, charge another $3,000, $4,000, $5,000 to another potential person who wants to rent to own, and they will go ahead and sell it again on a lease to own or a rent to own basis. So from a seller perspective, it's a pretty good position to be in, but from you as a buyer, it's also a good position to be in if you are serious about wanting to buy that particular property. If you don't want to buy that property, don't participate in this type of program, because the higher rents and things won't make any sense for you. However, if you do want to own a home in that area and you are moving ahead, this is typically a great program and gives you an option to rebuild that you might not have had for years down the road. So if you have any more questions, you can check out our website at homewithtom.com or check out our blog where we've got training videos and other information at madisonhomesales.com. That's madisonhomesales.com. Thanks and have a great day.